Joining me now, Ed Kohlberg is with AM Best. Ed, so great to see you. Thanks for joining us this morning.
Of course, Jeff, good to see you.
It's great to see you as well. Thanks so much. And I think this is an important topic. We're going to get into the kind of the role of AM Best as a credit rating agency, but also some of the recent findings as it looked into the life insurance industry. Let me ask you a basic question, just so I can level set with the audience. As a credit rating agency, what is the role of AM Best in its evaluation of life insurance companies or even governments?
Yeah, sure. So AM Best, we're a credit rating agency, global. We focus on the insurance industry, property casualty, life, annuity, and health. I focus on the life and annuity industry. So through our credit rating methodology, we look at the balance sheet strength of organizations, their operating performance, their business profile, and their ERM programs. We have our own, what we call our BCAR, which is our own capital model, which we utilize as part of the balance sheet strength analysis. So we'll give companies that we rate a credit rating, and we find it very valuable for the industry to rely on our ratings. And we also do other things such as publications, special reports, as you're seeing here. And also, we get involved in industry conferences as well.
Yeah, I mean, I've known AM Best. I don't know you personally, but I know the organization very, very well from evaluating lots of different products and services in specifically to the retirement industry. So let's talk about I think Limbra just reported recently that annuity sales, life insurance sales have been up significantly. That's great news because people are saving for retirement. They're thinking about their financial future. But what does that mean when a firm like AM Best is looking at the underlying company providing that guarantee?
Excellent question. Yes, we're seeing quite a bit of growth in the annuity space, as the LIMRA market report has shown. Some companies are growing very fast, and we've seen a lot of new companies come into the marketplace to come in and participate in that growth. Some organizations that have been in business a long time, it has seen that growth as well, mainly in the annuity line of business. So what we look at is we want to make sure that companies that are growing fast, that they have the capital to support that growth. Not only the capital for the current year's growth, but capital to support their future years' plans of growth as well. With that growth, companies are looking to invest in assets that can back the guarantees that they're putting out for their annuity business. And some of those assets come with additional risks. And within our capital model, we risk charge those assets. So, not only do companies have to support the reserves, but they also have to support the assets that they're using to back the liabilities as well.
So, a life insurance company, if you buy a product from them, you pay them a premium. That premium goes to the company, but they have to, if they're providing some type of guarantee, whether it's payment today or in the future, they have to keep certain amount of capital on their books. They don't just keep it in, I'm paraphrasing, you'll correct me if I'm wrong, but they'll keep it on the balance sheet. They'll invest it, perhaps. We'll talk about that in a few minutes. And that's how they're able to grow their own business, but also backstop these guarantees, these products.
Exactly, and that's how they get their profit as well by having a spread. And this is mainly for the annuity business. It's very, interest sensitive, spread based business and capital intensive as well. So that they invest it in an investment and give part of that return as part of the guarantee that they offered when writing that product. And anything over that guarantee is what is their spread that they've earned that they use to grow their capital, right, to support future growth.
And in terms of let's talk a little bit about the investing. And I'm not an investment expert. I play one on TV sometimes or on your phone. But how typically do these types of products, how does the insurance company invest? Are they investing in traditional equities like the stock market that you and I would invest in within our 401k or individually?
No, very good question. So through the life insurance industry, we don't see a lot of investment in equities. Common stock can be very volatile, right? And the company wants to make sure that they have liquidity and that they have earnings that they can match against the guarantees that they're putting out there. So what we see is a lot, mainly investing majority in bonds, fixed income securities. There's corporate bonds, of course. But what we're seeing more often is companies look towards private credit, private bonds, which have a higher yield than the public bonds. And, of course, there's been some headlines of concerns in the private credit market with BlackRock and Blue Owl are the two companies that come to mind where there's been some news and concerns over that. But, companies have to be well versed in the assets that they're using to back the liabilities. Private credit is a broad term, right? I think a lot of the issues that are coming up now are in AI and tech. There's all sorts of other type of private credit investments that companies are using, and not heavily concentrated in that area. So that's primarily what we see is fixed income, also mortgage loans. Companies use mortgage loan that they do their own underwriting or utilize other companies' underwriting. And one last point there is we're really seeing a push in investment managers coming into the life insurance space and starting their own or buying a life insurance company to start writing annuities and use their asset allocation acumen to help back those assets.
Yeah, I can certainly see why it would be attractive if LIMRA is saying the growth of annuity sales in particular are growing. I think one of the things we talk about in the retirement industry is retirement income. Those are kind of like annuities, but they're in the plan. So a lot of people have come in. Let me ask you in the remaining time, we've got about 2 minutes left, but in the remaining time, if for retirement plan advisors out there or people that are helping one-on-one, working one-on-one, I mean, are there some lessons from the report in terms of the additional due diligence that you should be doing as an advisor for an individual?
Yeah, I think for an advisor, it's all about suiting the need of the client and where they are in their life cycle and what their goals are. There certainly are opportunities with annuities, and a lot of the growth in annuities or MIGAs, multi-year guarantee annuities, which are, shorter term, right? They're maybe 3, 5, 7 year, where you can get a better return than maybe a CD. And we're seeing the banks aren't really providing longer term guarantees on the CDs. They're shorter term that they're offering. That's where the MIGA space kind of has come in and provided an opportunity there for those year durations. So that's where there's some opportunity, but it really depends upon the needs and the goals of the retiree.
Yeah, and I should have asked you this last question at the beginning, but I didn't think about it until the end. Hence why I'm asking you now. But in terms of the change in ratings, what's the frequency by which you would look at an insurer? Is it monthly, weekly, quarterly, annually? What's the typical frequency that someone looking at these ratings would know that they would change?
Great question. So it's constant surveillance. We're constantly looking at the companies that we're assigned in our portfolio. That being said, we're required every 12 to 13 months to bring the rating of a company to rating committee to look at it to either affirm the rating or change the rating depending upon what the outcome of that rating committee would be. But we're constantly surveying our companies. If something comes up where an event-driven rating is warranted, we will relook at that company, bring it to rating committee, and decide upon what the correct rating should be.
Yeah, I mean, it's a fascinating business. I think a lot of people, before I kind of got into this business, I had no idea that this took place. And we're going to have to leave it there. Excellent insight. Thanks so much for joining us. And look, we look forward to having you back on the program again very soon, sir.
Of course. Thank you.
Well, thanks for watching. And don't forget, we're back again tomorrow morning with another great expert and another great topic. You can tune in right here Monday through Sunday at 7:30 a.m. Eastern Time. And don't forget to subscribe to our daily newsletter, The Morning Pulse, for all the news in one place, delivered directly to your email box. Check it out at our website.